On the morning of September 15th, 2008, a man walked out of the Lehman Brothers headquarters in Midtown Manhattan carrying a cardboard box. Inside it, a coffee mug, a photo frame, 14 years of his career. By noon, the 14th largest investment bank in the world no longer existed. By midnight, stock markets from Tokyo to London were in freefall, and by the end of that week, the entire global financial system, a system built over a century, trusted by billions, was 48 hours away from a total shutdown. Not a recession, not a correction, a shutdown. Here's the part that should unsettle you. Nobody broke in, nobody sabotaged anything, no war, no pandemic, no asteroid. The system did this to itself, deliberately, slowly, and with complete approval from the people who were supposed to stop it. This is the story of how the smartest people in the room built the most elegant machine for destroying wealth in human history, and convinced everyone else it was a miracle. Let's go back, not to 2008, further. It's 2002. America just survived the dot-com crash. Then 9/11. The economy is bruised. The Federal Reserve, trying to keep things alive, does what central banks do when they're scared. They slash interest rates. Cheap money floods the system. Banks can borrow at almost nothing, so they need somewhere to put it, something that pays more than nothing. They turn to housing. Now, here's something you have to understand about housing. For the most of the 20th century, getting a mortgage was genuinely hard. You needed a stable job, decent credit, a down payment. The bank lent you money because they were going to hold that loan for 30 years. They had skin in the game. Your problem was their problem. That relationship was about to be permanently severed. Someone on Wall Street had a very clever idea. What if you took thousands of mortgages, thousands of individual borrowers paying monthly, bundled them together and sold that bundle as a financial product, an investment? They called it a mortgage-backed security, an MBS. In theory, it was elegant. If one person defaulted, it didn't matter because you had thousands of others still paying. You diversified the risk, spread it thin, made it safe. That was the pitch. Here's what the pitch left out. When you bundle mortgages and sell them off to investors, the bank that issued the original loan no longer owns it. They sold it. So now, for the first time in history, the bank that lends you money doesn't actually care whether you pay it back. Think about that sentence again. The bank does not care if you pay it back, because by the time you miss your first payment, that loan has already been sliced, repackaged, renamed, and sold to a pension fund in Norway. So what happens? Banks stop caring who they lend to. Mortgages start flowing to people with bad credit, no income verification, no down payment, sometimes no documentation at all. They were called ninja loans. No income, no job, no assets. And they were perfectly legal. A mortgage broker in Florida is handing a home loan to a strawberry picker earning $14,000 a year for a house worth $720,000. This actually happened. It became famous. The broker got his commission, the bank sold the loan, the investor got his security. Everyone got paid, everyone moved on. The only person left holding real risk was the borrower, who of course had no idea what they'd signed. Now here's where it gets almost absurd. Wall Street wasn't done being clever. They took those mortgage-backed securities, the ones that already contained risky loans, and bundled those together into a new product, a bundle of bundles. They called it a collateralized debt obligation, a CDO. The logic was even if some MBS go bad, you spread the risk again, double diversification. Then they took the riskiest slices of those CDOs, the parts nobody wanted, and bundled those together. CDO squared. At some point, you have to ask, what is actually inside this thing? Nobody knew. That was quietly the point. And here's the part that made the entire machine run. The credit rating agencies, Moody's, S&P, Fitch. These are the firms that are supposed to tell you how risky a product is. They stamp it with a rating. AAA means safe as government bonds. Junk means you might lose everything. Thousands of these CDOs, products stuffed with loans made to people who couldn't afford them, were getting AAA ratings. Why? Because the rating agencies were paid by the same banks creating the products. You are paying me to grade your homework. Of course, I'm going to give you an A. By 2006, half of all new AAA-rated debt instruments in America were mortgage-backed. Half. In a functioning system, AAA is rare. It's reserved for the safest things on earth. It was being handed out like loyalty cards. Meanwhile, the housing market is doing something it has never really done before at national scale. It's going straight up. Prices rising 10, 15% per year. People are buying homes they can't afford because everyone knows, everyone believes, prices will keep rising. You can't lose. Buy now, refinance later, sell for a profit. Optimism becomes infrastructure. The entire machine requires prices to keep rising. The loans, the MBS, the CDOs, the insurance products written on top of those. Everything runs on one assumption. Housing always goes up. In 2006, it stopped going up. At first, it was quiet. A few missed payments in Ohio, defaults creeping up in Nevada. Nothing alarming on the surface. But inside those CDOs, inside those bundles of bundles, the math was already broken. The cash flows that were supposed to pay the investors were drying up, and because everything was so interconnected, because every major bank on Wall Street had bought these products, insured these products, bet on these products, the damage wasn't isolated, it was everywhere simultaneously. Bear Stearns collapsed in March 2008, absorbed by JP Morgan for $2 a share. 2 months earlier, it was worth $84. Fannie Mae and Freddie Mac, the two firms that backed nearly half of all American mortgages, nationalized in September 2008. Then Lehman. And when Lehman fell, the machine didn't just slow down, it jammed. Banks stopped trusting each other. The overnight lending market, the pipe through which money flows every single day just to keep the lights on, froze. The Secretary of the Treasury later said that without emergency intervention, every ATM in America could have stopped working within days. Not a metaphor, literally, the ATMs. 8 million Americans lost their jobs. 6 million lost their homes. Trillions of dollars in retirement savings vanished. The people who built the machine were largely fine. Many received bonuses in 2008. Some were rescued by the bailout they helped necessitate. The mortgage broker in Florida had already moved on. The ratings analyst had already been promoted. The system didn't punish the people who broke it. It punished the people who trusted it. And here's the thought I'll leave you with. Everything we just walked through, the complex instruments, the misaligned incentives, the ratings fraud, the borrowed optimism, every single piece of it was legal. No fraud conviction required. Which means the real question isn't how this happened. The real question is, what exactly has changed since then to make sure it doesn't happen again? Because if your answer is the regulations, I'd encourage you to look up how many of those are still in place. And if your answer is the banks learned their lesson, I'd just say the machine is still running. It just has a different name now.